If you're running the wheel on a stock you actually like, you might be leaving money on the table. Not because the stock is wrong, not because your market outlook is wrong, but because of how you're getting paid. Same stock, same conviction. But instead of collecting premium from one side, you collect it from two. That's the difference. Today's strategy is called the Covered Straddle. And if you accept the extra risk, it can quietly outperform the classic wheel. Let us show you exactly why this strategy works and how you can find trades like this on Option Samurai. If you really like a stock, there's a more aggressive way to run the wheel. It's called the Covered Straddle, and it lets you collect more premium right from day one. But that extra income comes with more responsibility, and yes, more risk. At its core, a covered straddle is very simple. In the classic wheel strategy, you usually start by selling a put. If you're assigned, then you move on to selling a call, which can then be called away if your option ends up being in the money, and you restart the strategy by selling a new put. With the covered straddle, you don't wait. You already own 100 shares of an underlying stock in your portfolio. And immediately, you sell a put and a call selecting the same strike and expiration. What does that give you? It gives you the same payoff shape as a short put in the classic wheel, but with more premium collected upfront, which is why we gave it the super cool name, Wheel on Steroids. And that also means more risk. And no matter what the stock does, one of the two options is expiring worthless, leaving you the whole premium as a profit. That's the core appeal of the covered straddle. You've just heard us refer to this strategy as the wheel on steroids. It may sound like a joke, but there's actually a reason for it. You use it the same way you'd use the wheel. Perhaps you want to own the stock at a lower price, or you are fine with owning shares to collect a dividend. But now, instead of getting paid from one side, you're collecting premium from the call and the put at the same time. That means more income up front and a higher maximum profit. But it also means more obligation if the price drops, as you may end up getting assigned 100 shares, effectively owning 200 of them. And clearly, this strategy is not for every stock, and it's definitely not for every situation. It works best when a few conditions line up. First, you want a neutral to slightly bullish outlook. Second, and this one is super important, you should look for high implied volatility. The reason is simple. When implied volatility is high, option premiums are inflated. And since you're selling two options, that works in your favor. Next, you should only consider this strategy on a high-quality stock you're happy owning in the long term. And due to the nature of the strategy, dividend-paying stocks are ideal for this setup. And finally, you need enough margin to handle assignment. Let us make it very simple. This is not a trade you use when you're hoping the stock holds. It's a trade you use when you're confident holding the stock. But there's one case where this strategy can go very wrong if you don't understand the mechanics, which is why we need to take a look at different scenarios. Let's be very clear about the trade-offs. We will start with the simplest case. If the stock goes nowhere, you keep at least a part of the premium. And if the stock pays a dividend, you keep that too. Now, let's say the stock price moves up. Here, you hit your maximum profit. In this case, you are done. You got paid, and your shares will likely get called away since the call is now in the money. Now, let's look at the other side. If the stock drops modestly, you get assigned on the put. You now own 200 shares at a lower average price. And if you like the stock for the long term, this is still part of the plan. Finally, this last scenario is the one you must really keep in mind. If the stock crashes, losses accelerate. This is the real risk of the covered straddle. This is why the covered straddle is not about tight risk limits. It's about conviction, patience, and capital. If you don't have those, this is not the strategy to use. The good news is, there's a very specific way we screen for the covered straddle to give you an edge when trading options. Before we go on, if this breakdown was useful and helped you see the wheel differently, hit like and subscribe so you don't miss future strategy deep dives like this. Now let's look at how you can screen the whole market for the covered straddle setup with Option Samurai. First of all, log in and check out the scans page, where you'll see a list of predefined scans. Next, click the wheel tag. Now you'll see two scans. One is the regular wheel, which starts with a naked put. The other is the wheel on steroids, which starts with a covered straddle. Let's click that one. This scan is designed to find stocks that aren't too volatile, with a beta close to 1, and a dividend yield above 3%. It also looks for options expiring at least 4 months out, plus a few other filters we like. Now, if you select a trade, you'll see the exact structure we described. You start with 100 shares, and you sell a call and a put. From here, you can change anything you want. Just click Duplicate to create your own copy of the scan, then change the filters or add new ones with Add Filters. And don't forget to hit Save so you can always come back to your version. See, that was easy. And if there's another strategy you'd like us to break down like this, maybe a variation of the wheel or something completely different, let us know in the comments. The wheel is great, but just like we showed you, if you really like a stock, you have the chance to build a better version, as long as you respect the extra risk. If you want the full breakdown, real examples, and the numbers behind this strategy, check out the help article linked in the description. On Option Samurai, we share many tips to help options traders succeed, so go ahead and start your 2-week free trial with us and trade like pros do. And if you wish to learn more about how to trade options with us, click on this video and check out our channel.